There you go.
Great. Well, good morning and welcome on behalf of the Financial Inclusion Commission to this virtual summit on insurance. I'm delighted that not only do we have a distinguished lineup of speakers, but we've also got, I think, 80 plus people who've registered, not all of whom have managed to join us just yet, but we hope they will in the course of the next few minutes. I'm Chris Pond, honoured to be chair of the Financial Inclusion Commission, which, as many of you will know, is an independent body made up of parliamentarians from across the political spectrum, policy experts, and representatives of business and consumer interests. We're supported by HSBC, Link and Santander, but remain wholly independent. Now, our aim is to work with others to raise the profile of financial exclusion in public and policy debate, and to work towards measures which will tackle that exclusion. And this is the third in a series of virtual summits organised by the Commission this year with the expert assistance of Heidi Oliver from Absolutely Admin. The first of those was addressed by Sir Hector Sants, Chair of the Money and Pension Service, and by Right Honourable John Glenn, who was then Economic Secretary to the Treasury. And I do want to take this opportunity to thank John for his commitment as Financial Inclusion Minister to raising this issue within government. And we're looking forward to working with him in the future in whatever role he takes on. The second virtual summit focused on the role of regulation in combating exclusion and was addressed by Sheldon Mills, Executive Director of Policy and Competition at the FCA. And we're planning a similar event in the autumn, focused on financial education with Martin Lewis, who, as you will all know, is passionate about finding ways to better equip young people with the money management skills they'll need to navigate today's exceptionally difficult circumstances. So I'm going to hand over in just a moment to Johnny Timpson, who will take us through today's event. But first, to Heidi of Absolutely Admin, who will take us through some of the housekeeping. Over to you, Heidi. Thanks.
Thanks, Chris. Welcome, everybody, on this hot day. So just to really quickly run through, everybody knows what Zoom's all about and how to use it. But I'll just quickly run through what we're doing today. On the bottom of your screen, you'll see the mute button. If you can keep yourself muted in case there is any background noise going on while people are obviously doing their speaking and they're presenting. And then on the bottom of your screen, you'll see the word participants. If you click on the word participants, it will bring up the list of people that have managed to join us today. And at the bottom of that list, you should be able to see a raise hand button. We would like you to use the raise hand button so that then we can call you in if should you wish to intervene with the conversation or any other discussions that are going on the Q&A sessions. If you don't wish to actually come across and put your hand up to actually speak and bring your point across, you can actually use the chat box. At the bottom of your screen, you'll see the word chat. If you click on there, it will pop up on the right-hand side of your screen. If you want to network with anybody, use the chevron next to the word everyone, and then you can network with each other personally. It will just go through to that one person. If you wish to share links, as Martin has just shown us how to do, just use the everyone button and it will go to everyone and everyone can see what you're sharing. Most people have got their names on the screen, and there are a couple of you which I know the names just by your surnames and stuff, so I will change your name if you don't mind. If you can, obviously, what we do like is obviously your name, surname and your organisation name, just so we know who you are. Today's session will be recorded and we will be sharing this on the Financial Inclusion Commission website after the event. There isn't actually any PowerPoint, so you'll be pleased to know we're not going to be PowerPoint board today, so it's all going to be lovely chatting going on, so that's great. If any of you have actually used the link from Eventbrite, you may not be able to get all of the buttons at the bottom of your screen and things like that. So if you are struggling to get the chat box up or anything like that, please come out and use the link that I sent in the invite in the join instructions. Apart from that, I think we're all okay, and we're going to have a nice little break to have a bit of a fan session and top your coffees up or your waters. Apart from that, enjoy the session, and I'll pass you back over to Johnny Timpson, who's going to chair the rest of this meeting. Thanks ever so much for the opportunity. Thanks, guys.
Well, thank you, Heidi, and thank you, Chris. Well, good morning, everybody, from a very hot and Scotchy or North Berwick in East Lothian in Scotland. When it gets to 15 degrees in this part of the world, it's hot. When it gets to 25, it's scorching, and that's kind of where we are today. Right, well, as I say, welcome to this session. And I think it's timely we have it, since given last week we had a whole flurry of information thrown at us, really from the regulator initially. He was commenting that we really need to double down now in improving support for vulnerable customers and those impacted by the cost of living crisis. Regulator was pointing to the fact that inflation rates are going to 10, 11%, but for people in lower income groups, the real effective rate of inflation is probably more likely to be 14, 15%. And I think that's something we need to bear in mind. But last week also saw the Resolution Foundation, Nothing Foundation, and the Centre for Economic Performance jointly released their Stagnation Nation report and thoughts on how we navigate to a fairer, more inclusive, more prosperous UK. And that report makes for pretty stark reading. It speaks to a toxic combination of slow growth and high inequality, posing real challenges for low to income earners in particular. Living standards and financial well-being and resilience all being impacted and reducing. And that research was done before the post-COVID pandemic and the impact of the crisis in Ukraine. And to give you share some numbers from that, real wage growth in the UK for the period 1970 to 2007 saw across each decade wages grow by about 33%. But from 2007, from about 2007 to today, wage growth in the UK has fallen to zero and below zero in a number of instances. Income inequality in the country in 2018 was higher than any other large European nation. And within the UK itself, if you look at average income in 2019 in Kensington and Chelsea, the most affluent area of the country, was £52,500. But let me contrast that with Nottingham, which was the lowest year, coming in at £11,700. That is where we are in the UK today. We have 8 million younger workers who've never worked in an economy with sustained average wage increases. And those born in the 1980s are half as likely by age 30 to have got a mortgage and be in their own house as those that were born in the 1950s. And it wasn't just the RF, Nuffield and CEP that were throwing out that information. Aberdeen Foundation also reported last week that 1 in 6, that's 4.5 million households, are now in serious financial difficulty and going south. And only about 15 days ago, a week or so ago, we saw the chief executive of Lloyds Banking Group, Charlie Nunn, and he was commenting that on the across their bank, and that's the biggest retail bank in the UK, and quite a key barometer for where and give you a pulse check in where UK consumers are. Lloyds were commenting that credit card spending is increasing at its fastest rate in 17 years. 75% of Lloyds Banking Group customers are worried about the cost of living. 20% already cutting back, seriously cutting back on discretionary spending. And I think the stark figure for me was 80% of Lloyds Banking Group current account and savings account customers had less than £500 in savings. Let's put £500 in savings in some context. That's a washing machine. That's a fridge. That's a TV breaking down and needing repair. That's at the current rate now. That's basically 4 car tires. It's, as I can tell you from personal experience, it's 50% of a car timing belt change, and it's 1/3 of the average flat rent in Edinburgh. That's where the financial resilience of the UK is right now. All the reports indicated that the hardest hit groups were low-income households, particularly single-parent families, renters of all ages, people that are living in high-rise blocks with cladding. They are the groups that are most exposed to shocks. Now, insurance has a key role to play in safeguarding consumers to financial shocks, helping consumers improve and manage their financial resilience. And that's a point really I'd like to, in this call, flag to the Money and Pension Service because they are the custodians of our UK financial capability strategy. And quite frankly, I think there has to be more focus on that strategy, on the benefits of appropriate insurance. In this workshop, we're going to focus on two areas. First, in the first section, general insurance, and we'll look at motor insurance contents for renters, flat owners, and those who live in flood-impacted areas. They're facing real issues in terms of accessing affordable and appropriate insurance. And to discuss this, we'll be joined by Graeme Trudgill, who's Executive Director at Biba, Helen Povah, who's the Public Sector Client Managing Director at Aon, and James Dalton, the Director of General Insurance Policy at the ABI. We'll then have a break, and our other session will be focused very much on resilience to income shocks. And we're joined there by Rob Wheatcroft, the Technical Manager at Swiss Re, Simon Hodgson, Head of Government Relations at Unum, Liz Barclay, the UK Small Business Director, and Laurence Raeburn-Smith, the Senior Policy Advisor for Employment at the CBI. But before we get into discussion, let me hand over to my Financial Inclusion Commissioner colleague, Martin Coppack, to talk about, introduce and really talk about the poverty premium and the need for the Financial Conduct Authority, and indeed all of us, to pay greater regard to financial inclusion. Martin, over to you.
Thanks ever so much, Johnny. Pleasure to be here. For those who don't know me, I'm Martin Coppack, and I'm Director of Fair by Design. We exist to eliminate the poverty premium. That's the extra costs poorer people pay for essential services. We cover 4 main markets now, actually: energy, insurance, credit, and increasingly payment systems. So I'm going to give a bit of an overview around some of the issues people who are poorer experience in the insurance market. Just to set the scene, I think we all understand now that we live in a country where we're encouraged to take responsibility for our own families, for our own needs. Increasingly, the term being used by the Institute Faculty of Actuaries is the great risk transfer, as governments and businesses increase the risk profile onto individuals rather than themselves. So we're all encouraged to save for a rainy day, save for retirement, protect ourselves if something goes wrong in terms of an income shock. All encouraged to look after ourselves, be a good citizen, be a good consumer. Look to the market to fulfill your needs. However, what happens if the market just doesn't want you? It might be past ill health. It could be in terms of you can only afford to live in an area which has been deemed more risky. You as a person, you as a family are automatically now increasingly being described as less desirable, not a good risk. And this situation will only get worse as we move from a pool risk approach in insurance to one of individualized risk. And technology gets even better, making to understand individual risks. Now, I put in the chat function a report that we did with the Institute Faculty of Actuaries. Never worked with actuaries before. Gosh, do they know their stuff? And really pleased with that. So I would encourage you to look at that link after this presentation and this event. We would say now at Fair by Design is that the market is becoming ever more efficient. And often people think that's a really good thing. However, our experience and the experience of people in poverty who we work with is that the market is increasingly chasing the healthy and the wealthy. At the same time, consumers and their representatives, people like myself, cannot challenge insurers in terms of how they do their work, do the calculations that they do, because it's commercially sensitive. It's one of the most opaque industries in the whole of the UK, and that opaqueness is highly guarded. This has led to some really interesting isn't the word, concerning questions around discrimination within the market and protected characteristics. And even though organisations such as Citizens Advice talk about the ethnicity premium, and people from the insurance industry may criticise their calculations, still will not open up their books to a trusted party so we can all have a better understanding about how the market does its calculations. Now, people in poverty already pay a premium for being poor. It goes across those markets I mentioned we work in, but also things like food and transport, those essential things that we can't do without. But what's really interesting and concerning is that insurance is now becoming the biggest part of the poverty premium. Take car insurance, for example, which is a compulsory insurance. People, depending on where they live, can pay up to another £300 a year for that insurance. But also, if they can't pay up front in one go, can pay up to another £140 for the privilege of paying monthly. But these are the people who can least afford those extra costs, the extra costs for being poor. What's more, we did some really good research with Bristol Personal Finance Research Centre, I think it was last year or maybe the year before, which also demonstrated how the market is increasingly discriminating. Lots of different markets, essential services markets, are discriminating against different people with different personal characteristics. Even if the discrimination within the market is indirect. Insurance, for example, we found, well, Bristol University found, which we commissioned, that if you're from a racially minoritized community, if you're disabled, or if you're a lone parent, you're much more likely to be without insurance, leading to exclusion, but also people paying over the odds when something goes wrong. And we call that the latent poverty premium. At the same time, we all know that income shocks is one of the biggest reasons people fall into problem debt. 14 million people experience at least one income shock in a year, and that rises to 4.5 million in terms of people who experience 2 or more income shocks. And millions of pounds are spent on bankruptcy, debt write-offs, debt advice. Wouldn't it be better if we tackled this by affordable and more comprehensive insurance across the country, saving all this money and saving all this misery? So what needs to be done? Insurance privately will say to me they understand this issue, but very rarely will they publicly talk about this issue. And that's because it's a market-wide issue. And if one individual insurer was to go against the trend at the moment of individualized risk profiling, they would lose market share. Totally get it. What we need is a market-wide approach. For Fair by Design, we talk about 3 main barriers in the insurance market. 1, a belief in competition, meeting everybody's needs. Choice exists for all, empower consumers driving the market. Simply not true for everybody. A real lack of ownership of poverty and exclusion issues between government and regulator. And also a lack of a joined up approach between industry, government and regulator. As I mentioned earlier, Fair by Design works with people in poverty. And at a recent workshop we did with people in Scotland with Poverty Alliance, people told their stories of engaging in the insurance market. And it really brings a light into frustration and the negative outcomes that people experience in the community. For example, one person said, where I live in Scotland, if I cross the street, I lose 16 years of my life. It's pretty much the same when it comes to insurance. Somebody else was saying, I'm disabled, I absolutely have to have my car. Another person saying, look, my insurance is just way too high, so now I just use my sister's postcode. I dread to think what will happen to her if she does have an accident. Also, we did some work with Toynbee Hall in the East End of London, and people were using phrases like, I feel discriminated. And I know for people in the industry, that might not chime as the correct word, but in terms of people out there, they feel it. I remember one person in the East End of London saying, I pick up the phone, they ask me what postcode I live in, and then they say, we don't serve you. We've also commissioned some research with Social Market Foundation, which we will be discussing at the party conferences, and we'll be launching later on in autumn. And what's really interesting in that research too, is that the stats are pointing to against the usual argument from regulators, businesses and government that people are just not good enough at finding the best insurance. If only we could fix the consumer, let's just educate them. Let's do a bit of a signposting system. Actually, no, people are just saying it's too much. They can navigate the market, but it's just too pricey. So I've talked a lot about the problems. In terms of the solutions, I'm afraid to say it does involve industry, government and regulators working together, and it's just proving so hard. There's a real need for a mixture of social and regulatory policy intervention. We've got lots of recommendations in the report I put in the chat function for the Institute of Faculty of Actuaries report we did. But just to pick out two. First of all, can the FCA look at the market and look at the pricing and see whether it's fair and reasonable and in line with the Equality Act? And also, how are the needs of the people in the most poorest areas being met? Once we have that clarity, we can then go to the Treasury and say, this is where the social policy needs to come in. I cannot emphasize how many times over the years I've spent going to the Treasury and they're saying you can't prove market failure, go to the FCA. Go to the FCA, they say, well, it's a kind of social policy this, can you go back to the Treasury? Oh no, why don't you try the Competition and Markets Authority? They'll say, go back to the sector regulator. Then you might go, what about the Equality Human Rights Commission? Go over there. Oh no, they don't have the ability, but the FCA does. Round and round you go. And I've been doing this circus for about the last 10 years. That's why we're calling for the Financial Conduct Authority to have a must-have regard to financial inclusion in the finance bill, just so that they can actually think about, it's kind of crazy when you think about it, the national regulator for financial services in the UK doesn't even have to consider financial exclusion or financial inclusion, doesn't have to even consider. All we're asking for is that the FCA has a new must-have regard to consider the needs of the most vulnerable and excluded, so that they're more able to engage in getting the right data, because industry is not going to share it, getting the right data, saying how fair the market is working, and then making it plain who should intervene. On that point, I'm going to be quiet and I look forward to a healthy debate. Thank you.
Martin, thank you. That really does set the scene. And I guess to some extent, you know, it also the timing of the poverty premium research, you know, couldn't really be better, because we now have the FCA bringing forward our new consumer duty regulation. We'll find out more about that, I think, within the next couple of days. We're expecting something by the end of the month. The new consumer duty requires all of us in financial services to improve customer value, to improve customer understanding, customer support, and improve customer outcomes. And I think to some extent that really does chime with a number of the issues that you've raised there. You know, where I think we need to ask ourselves, how do we improve value and make competition work for everybody? And how do we get to a point where we have that joined up debate between the regulator, the government, and the industry about recognizing the issue that more vulnerable consumers have, and ensuring that they do have ready access. So at that point, let me introduce Graeme and Helen and James, and let's really dig down a bit and maybe focus on some real issues that some consumer groups have. Martin referenced drivers, but there are also renters, particularly those living in social accommodation, people that are living in cladded buildings, people living in flood areas, and those who have disabilities and health conditions seeking any form of insurance, but particularly travel insurance. So, Graeme, can I just introduce you? If you want to maybe just kind of introduce yourself and then basically give a kind of Biba view of where we are and what we need to do to improve outcomes and what the barriers are where maybe the Financial Inclusion Commission could help.
Sure, thanks, Johnny, and thanks everyone for inviting me here today. It's an honour to be here. So I'm Graeme Trudgill. I'm a former general insurance broker, but I'm the current executive director at the British Insurance Brokers Association, Biba, and we run a fund insurance service, and I work very closely with Johnny and many others here on helping people to access insurance. So let me go through a few opening remarks. I think Biba absolutely appreciate that times are exceptionally hard for very many people at the moment, and we want to do all we can to help. We have our own manifesto of the issues we want to achieve during the year, and our 2022 manifesto covers a number of issues that we're very mindful of, that they are relevant to financial inclusion, and we're keen to work with all stakeholders to find a path through so that people can more easily access the suitable insurance that they really need. So to give you an idea of some of the areas where we're looking to help, First of all, I'll mention people on universal credit seeking to rent a property. Now, there's barriers there from landlords citing insurance as the issue. And that's why we're working with the charity Shelter, because it's an absolute myth that landlords' buildings and contents insurance contain a no DSS clause. We have hundreds of members who have policies with no such a clause. So insurance should not be considered a barrier to tenants on universal credit having a roof over their heads. Johnny also mentioned young drivers, and I know young drivers often find motor insurance unaffordable. I've got a couple of teenagers and it is expensive. And so they either risk not driving at all or risk driving uninsured. But motor insurance is not an option. As Martin said, it's a legal requirement. And young drivers pay more than experienced drivers due to that risk. But with advances in technology now, many motorists can take more control of their premium by considering a telematics policy. So, for example, by putting a small black box in their car or downloading a pay-as-you-drive app on their phone, their premium can then be calculated according to their own behavioural driving, like their speed, the G-force, the mileage, etc. And that can mean major discounts can be earned by young drivers who are the group paying the highest premiums. So they can save sometimes as much as 25%. And there's also important road safety benefits with telematics for newly qualified drivers under 25 who are 3 times less likely to have an accident with a telematics policy. Now, Biba has an access to insurance committee, and that's chaired by the former FCA Consumer Panel member Caroline Barr, who is a non-executive director of the Biba main board. And this access committee oversees our 4 signposting agreements. And for anyone who doesn't know what a signposting agreement is, I will briefly explain. It's a commitment from firms that if you cannot place a certain time of insurance risk for a customer yourselves, then you'll try and signpost it, the client, to a firm who can help that particular risk. Maybe they're a specialist, for example, or if you don't know who to signpost it to, you can signpost to a suitable signposting service like Biba's Find Insurance service. Now, Biba is a not-for-profit trade association, and our Find Insurance service includes both a website and a friendly call centre. So we can effectively act as a sort of a dating agency looking to match the consumer or the business with a suitable provider who can help them. So the 4 signposting agreements that we have, so we have the agreement on age and insurance for older people seeking motor and travel insurance. And this was launched back in 2012 to help with the Equality Act in partnership with the Government Equalities Office, with Treasury and the ABI. And in the last 10 years, it's received over 870,000 inquiries. And I know that the Minister John Glenn that you mentioned earlier has been very pleased with how that's progressed. The second signposting agreement is the agreement on access to protection insurance, something you yourself, Johnny, helped a great deal with. And that's for people with pre-existing medical conditions or with disabilities seeking life, income protection or critical illness cover. And that can do amazing things. Like even if you've had a heart attack, it can still find you a life insurer, for example. So that's a really important service. The third signposting agreement is the FCA Travel Medical Directory. And this follows the new rule in 2021 aimed at helping people with serious medical conditions more easily access travel insurance and go on a much needed holiday. So Biba and the Money and Pension Service have qualified with the criteria of those travel medical directories. So that rule is in place, and firms should be signposting people with those serious medical conditions to one of the directories. And then the 4th directory I'll mention is the new flood insurance directory that we put together with the ABI, with Flood Re and DEFRA to help those in flood risk areas find cover for their home, which hasn't always been easy, particularly if they're not qualifying for the Flood Re scheme. And we launched that in February this year. And then in addition to those 4 signposting agreements, we also work closely with the Ministry of Defence and our Armed Forces Covenant commitments to ensure Armed Forces personnel and their families can access suitable cover for their quite unique risks that they face. So they might have airside exclusions, sudden overseas postings, war exclusions, challenges themselves with things like affordability testing. And we're also working very closely with government and the ABI to look to reduce the cost of insurance for leaseholders in cladded buildings. And we welcome the recent announcement by government on the intervention on cladded buildings with the government-backed PI scheme for EW1 S1 assessors, which means if they can get that remediation work done more quickly, the cladding can come off, the insurance can be much more affordable. So that's some really good progress. Now, it would be remiss of me not to mention insurance premium tax. Insurance customers are paying a huge £6.3 billion in IPT, and this means young drivers, for example, people on benefits, even leaseholders in cladded buildings, are paying 12% of their premium to the government. And of course, travel insurance customers pay an even higher rate at 20%. But insurance is a social good, so we're very concerned with the amount this adds on to the average family bill, because they'll probably be paying IPT on their car insurance, their home insurance, their pet insurance, their travel insurance, their life insurance. It all adds up. So we now think this is the time for government to reduce that headline rate of IPT to 10%. And we think this should also apply to the travel insurance rate, bringing that down in line. There's no reason why that should be a different rate anymore. And then very briefly to mention contents of people in social housing. Our manifesto also covers how can people access low-cost home insurance if they're living in social housing. So we've worked closely with people like Helen from Aon, who's going to speak shortly, so I won't steal her thunder. But we'll simply say that cover is available at very low cost, but there's a very low uptake, and without the buy-in from the registered social landlords, it falls at the first hurdle. So hopefully those RSLs can work with the insurance sector, the government and the FCA in partnership to get these schemes some maximum penetration wherever possible. And insurance brokers can certainly provide all the tools to help there. But the FCA has to work on things like affordability testing, which works against the poorest in society, and they really need to rethink that rule there. So in summary, financial inclusion is very high on Biba's agenda, whether you're older, whether you have a disability, have a medical condition, or on universal credit, are in the armed forces, living in a cladded building, if you're a young driver, a tenant or a social landlord, or have a home in a flood zone. We're keen to help, and Biba brokers will always do their best to find a solution for our customer. Thanks, Johnny.
Graeme, thank you for that introduction, and that can be seen set and Biba response. Helen, I'm just conscious that the last Insurance and Financial Services All-Party Parliamentary Group, the chairman, Craig Tracy MP, was particularly concerned about the issues that people who are renting have accessing contents insurance, but particularly people in social housing. So I'd kind of welcome your overview of that issue, and again, you know, what are the things that we need to do to make a difference, and what are the barriers that you identified that perhaps all of us on this call, but particularly Financial Inclusion Commission, could help you shift?
Yeah, good morning, everybody. I'm Helen Povah, and I'm the Client Management Director for the Public Sector in Aon. We offer registered social landlords in the UK access to contents insurance schemes. So these schemes are tailored specifically for tenants or leaseholders of social housing, and they offer tenants or leaseholders access to contents insurance where they can decide how much and what type of cover they need. Tenants or leaseholders can pay for their cover in small increments, often weekly, without paying any interest, and allowing the tenants or leaseholders on limited incomes to budget more effectively. Now, most schemes have no excess to pay if they need to make a claim, and the premiums are calculated by area rather than the individual properties, meaning access for all. The schemes are recognised by the Financial Inclusion Commission and others as providing a vital safety net financial inclusion product for those that may not have access to insurance by other means. Aon currently work with around 90 plus registered social landlords in the UK, and we consider running these schemes to be part of our responsibility to provide financial and social value to communities across the country. For the schemes we currently have in place, part of the process is educating people on the importance of the product and reassuring people to have trust within insurance communities to pay for pay for claims. For example, we ask tenants on our existing schemes to provide testimonials of their experiences when they've submitted a claim, as we believe this provides reassurance and comfort within the communities around the service that we offer. At present, we are increasingly seeing tenants' contents insurance schemes being removed, often with no alternatives provided, as registered social landlords don't believe it's their responsibility to offer these schemes, which I couldn't disagree with more, as we feel it's a duty of care for the residents to ensure they can access financial insurance services, which actually benefits them as well. There are a few ways that we can offer the schemes within the market, either by the registered social landlord administering this themselves and receiving a commission to cover the costs associated, or they can outsource a third party to administer these schemes on their behalf. One of the major barriers that we have is we need all registered social landlords to offer access to these schemes, and whether that's by doing that with Aon or doing it by one of our competitors in the market, it really doesn't matter. It's just about offering these schemes for their residents to actually have access to this valuable product that we've actually got in the market. I think with the support from everybody on the call here today, and actually reiterating the importance of these schemes in the market and that they are available, will be a fantastic outcome. And that's everything from me so far. Looking forward to discussing it further.
Yeah, thank you, Helen. James, I just wonder if from an ABI perspective, if you can perhaps just kind of comment on the challenge that Martin has posed around the poverty premium and improving access to products that offer value for all, but equally some of the issues that Graeme and Helen have raised.
Sure, thanks, Johnny, and thanks very much for the opportunity to be with you today. I won't say too much. I'm more interested in responding to people's questions or comments, I suppose. A couple of points by way of introduction, though. Look, I would be the first to accept that the insurance industry has got more to do in terms of two things. One is explaining how insurance works and being a little more transparent on pricing in particular, to Martin's earlier point. One of the things that there's two things I'd point to, actually. One is in our own ABI governance, we have established a consumer committee and a consumer advisory group, of which Martin is a member, so that we can better hear from customers in a way that we, if I'm honest, haven't really done terribly well before, to hear from customers what their concerns are about how the insurance industry works and operates. And that is, I think, an important first step. The other thing that we've done over the years has been to try to become a bit more transparent. So one of the things that you would have heard a decade ago is we've got no clarity or transparency around what the price of car insurance is, for example, or home insurance, and which is why we've established our quarterly premium trackers, so that we are transparent with you and with the public around what the average price is for car insurance or home insurance, and you can track that over time. In terms of facilitating access to insurance, I won't repeat the long list of interventions and initiatives that Graeme mentioned, but a lot of those initiatives Biba and the ABI have worked jointly on, and will continue to do that in the future. I think one of the things that I wanted to say here was part of the challenge, in my view, that the insurance industry has in talking to consumers about insurance is if Graeme or I or anyone else from the insurance industry goes out to a consumer group and says, you should protect yourself by buying more insurance, one can appreciate that the consumer group takes that with a very large grain of salt, because it just seems like the insurance industry trying to flog more product. And I think one of the real absences that we've got in the space of financial inclusion is genuinely independent third-party voices that seek to explain to consumers the importance of protecting themselves, their loved ones, and their possessions through the use of insurance. Now, I take Martin's challenge. You know, you can do lots of explaining, you can do lots of signposting, and we have done that as an industry, genuinely. But I think it does have to come from trusted third parties like the third sector or indeed government. Give you a non-consumer, a non-personal lines consumer example. In terms of cyber insurance, for example, the number of times we've had a conversation with the small business community about the importance of protecting businesses through cyber insurance, I could retire on if I had £1 for each time I'd done it. They do not buy it. And the reason they don't buy it is because it's me or it's Graeme telling them that it's important to buy it. And I think you can draw parallels to personal lines insurance, whether that's property, contents, travel, etc. Two further comments, Johnny, if I may. One is there is a big overlay here, in my view, of social policy. There are reasons why certain segments of society suffer from poverty. The insurance industry has not got the levers at our control to change social policy outcomes. And we are an industry that prices risk, and we can be more transparent with how we do that, as I said earlier, but we are not going to stop people being poor, and we are not going to be able to get people out of poverty. That is a question for central and local government. And on the question of government, I just wanted to emphasise at a slightly higher level the point that Graeme made earlier. Government has a lot of levers at its control in terms of improving social policy outcomes, but also improving regulatory outcomes. And young drivers is a classic example of this. There is absolutely no doubt that young drivers are the most dangerous drivers on the road and consequently pay the highest car insurance premiums of any segment in society. There are ways that you can reduce the risk that young drivers pose, and government over the last 12 years has done nothing to improve road safety outcomes for young drivers. I have talked for years about the importance of looking to international markets like Australia, Canada, New Zealand, in terms of the introduction of graduated driver licensing schemes, which put some disciplines on young drivers, demonstrate that they can actually drive safely, and therefore the insurance industry can respond in terms of pricing that risk more effective and accurately. But I can't make young drivers do that. It's government that can do that. And I think the broader point that I think Graeme was making, and I would emphasise, is government policy has a key role to play in a number of these conversations.
James, thank you. And I think that's setting a point from the Financial Inclusion Commission that we're painfully aware of this kind of fact that we have a huge social policy issue here. And at the minute, Martin's better placed to comment on this than I am, but the ball seems to bounce between the FCA and the Treasury, with the FCA basically saying that's social policy is not in our remit. And I guess to some extent, you've got the Treasury basically saying demonstrate market failure. And we're kind of stuck in this kind of catch-22. I get kind of interested in your thoughts in terms of how we might collaborate to break that cycle.
That's a challenging question to answer, Johnny. I mean, look, I think I can't speak for Biba, obviously, but I certainly, from an ABI perspective, we have engaged with Martin and colleagues on issues associated with the poverty premium. I think joining up central government and regulators we have that challenge ourselves as an industry on the issues that we want to progress, right? Just look at Solvency II. There are big issues in terms of making that work, but if there's anything that we can usefully and meaningfully contribute to joining that up, then I'm certainly happy to have that conversation either with this group or with Martin or others bilaterally.
Yeah, thank you, James. We've got a question, Heidi, from Paul Walsh. Can we bring Paul in?
Hi, Johnny. Paul, how are you?
Very well, thank you.
Just to introduce myself, I'm the Chief Executive of Unum Mutual. We're the insurer behind the credit union market and mutual market across the United Kingdom and Ireland. Just like, if I may, Johnny, 3 very quick observations. Supporting what James and Martin have been saying throughout the call, there are mechanisms within the insurance industry to try and support people in a more egalitarian manner. And a simple example of this, people on the call might find interesting, is the credit unions in the United Kingdom have insured through group policies, and that's effectively not a risk-based policy. Nobody pays a discrete difference in premium. Almost 2 million people today, and that includes during the pandemic. And over the past 2 years alone, there have been tens of thousands of families have claimed that. Now, albeit that this is much smaller than the very large tickets, the very large policies that most people are familiar with from life cover up at 100, 200,000. These would be more modest sums, ranging from the hundreds into the tens of thousands. And just pleased to let the call, and certainly members on the call, know that actually there are group programs out there. The second thing is a point James made, Johnny, when supported by a trusted third-party brand, such as the credit unions or a CDFI or the housing body, actually people are less suspicious of insurers. And for obvious reasons. I mean, every time we do consumer research, the 3 top things, 1, insurers try to confuse you with their questions. 2, they never pay out on their claims. And 3, they try to find ways not to insure you again. And so there's a natural suspicion there that we need to overcome. But by working more simplified insurance products through trusted third parties, that is actually gaining traction, and that is beginning to work in the life and the protection market. Unfortunately, we haven't transitioned into the general market, and I think there's more challenges in that space. But this is definitely a work in progress, and I think this call is very, very helpful in helping to move that agenda along.
Thank you very much indeed, Paul. And that's an interesting take. I hadn't really appreciated that the scope for getting the group involved, but I think there's certainly more we could do. And from a Consumer Financial Inclusion Commission perspective, especially given the reach that we've got via colleagues like now Fair Finance into credit unions. Martin, can I bring you in?
Thanks very much. I just wanted to start off saying I actually agree with James on almost everything he said, and I'm really pleased about the new consumer advisory group that's been set up. I guess though, if we were to think about insurance which actually people are already persuaded is good, and it's already, they have to have it, which is car insurance, and is the biggest part of the poverty premium. If we just to take that section, I think there's a real opportunity to make a difference. It's not about consumer education or anything like that, because they've got to have it. But on that, I have to say, when I have meetings with officials, they always say to me, but what is industry saying? Can you have industry saying the same thing as you? How about if we go and talk separately to industry about this? I don't think people in business understand how much clout they have compared to a handful, a really small amount of third sector organisations with about 1 person, maybe half a person working on insurance each. Even Macmillan's got half a person on insurance, and that's a big one. Citizens Advice, it's probably got the equivalent of 1 full-time person. But we cannot get over those hurdles unless we have a united front and the industry can actually say, yeah, this is a problem, we can't sort it out on our own. So I just wonder, as a practical step following this, perhaps myself, maybe somebody from the ABI sits down with the Treasury and says, it's a problem. We can't sort it out ourselves. Do you want to help us? Something like that, just to get the next step.
I think that's a fair point, Martin. I mean, I spend a lot of time wearing my financial services consumer panel hat on, responding to consultations. And I think what's become more noticeable over the last year, 18 months, is increasingly the panel is the only consumer body, if you like, that's actually responding to consultations, because given the pandemic and the challenges that that's posed on charities, the charity resources just dropped away. I guess it's maybe one to bring in Graeme and James, read that offer of kind of getting joined up with Martin. And perhaps James, is that the kind of the purpose of the ABI consumer body you've just put in place?
Yes and no. So I mean, I don't want to prejudice the outcomes of the discussion of the consumer advisory group of which Martin is a member. I suspect that there will be a number of issues discussed in that forum where consumer representatives want industry to take action, and we will need to listen to that. Look, I mean, I'm certainly happy to sit down with Martin and the Treasury to talk through any issues that they feel we as an industry need to address. The one caveat to that, sorry, Martin, you've put your thumb up already. The one caveat to that is my view, and I certainly think the industry's view, which may not be entirely agreed with by Martin and others, but I'm going to say it anyway. UK motor insurance is possibly one of the most competitive markets on the planet. There are around 100 providers providing basically the same thing, which is car insurance in the UK, and it is a market that does not historically make money and it doesn't make money now, and it historically hasn't made profits. Now, that poses some interesting dynamics to a conversation about what the problem is. But the other thing I'd say is, and Martin alluded to this in his opening remarks, and I'm in painful agreement with Martin, that underwriting models, rating factors, and the weighting that an individual insurer places on a particular rating factor is highly commercially sensitive material. And I'm not sure you're ever going to get under that. You could get more transparency at an industry level, but I'm not convinced, for obvious competition law reasons, that you would ever get to a point where rating models were in the public domain. Now, you could then have an argument that says, well, maybe you need a regulatory framework that says a car insurer should only take into account these 7, 8, 10 rating factors. There's an argument for that. That's how a lot of US car insurance works. But it completely and utterly stifles any meaningful innovation in the market. And I'm not sure that's what a good consumer outcome looks like.
Thanks, James. Paul, your hand's up. Is that a legacy hand? If you're going to bring you back in? No. Martin.
I was just worried it's going to be a two-way conversation. Sorry, James. Yes, I'm not saying it isn't a competitive market, but my job is to represent people who are never in these rooms, the people with no voice at the table, both within regulators, within government, and often within industry. The people who are paying the highest. So I'm talking about those, and it might be that there's a specific solution for that proportion, but I'm definitely not saying it's not a competitive market. It's just a market that costs a lot when you're poor. Mm-hmm. I think I also understand about competitiveness. The data is very commercially sensitive. Got it, absolutely. The FCA can hire a few more actuarial scientists, and they can get under the bonnet. They can have a look at it. So it'd be great if we had support for that, because often that is the loophole we're in. Treasury says you haven't got proof. Go to the FCA. FCA, it's price. Go back to the Treasury. We're round and round and round. Wouldn't it be brilliant if we had an industry voice saying, actually, maybe this needs to happen for some type of trust to happen without the commercial sensitivity going elsewhere. And one other point I've got to say is, I wonder if there's something here the FCA and potentially in industry themselves can look at, which is cost to serve when you pay monthly. If you're paying up to £140 over the year for paying monthly for your insurance, I do question, and speakers of organisations have questioned, why is it so much, especially when you can cancel the insurance if the person doesn't pay on that month? And these are just big questions where some clarity, I think, would aid discussions. And it's all about bringing us all together on this.
So on the, sorry, Johnny.
On you go, James.
Yeah. So on the APR point specifically, Martin, we've done quite a bit of work over the last couple of months on premium finance and APR rates, and you know, I'm not promising you anything now on this call that I don't have a member mandate to do. But look, I think we will put something into the public domain soon-ish. On that. The one thing I would say, and I've talked to a lot of members on this over the last couple of months, the one thing I'd say is that premium finance offered by insurers as a customer service, recognising in particular in car insurance that it's a compulsory purchase, and people need their car to live their lives and go to their jobs, etc. The industry offering premium finance enables people who may not otherwise be able to afford to pay 450, 500, whatever the premium is, pounds up front. It enables them to split that cost over the 12 months of the policy. Now, we can have a debate around rates, and you could have a debate around you know, the forbearance measures that insurers might use for those who are unable to meet a monthly instalment payment. But the alternative to me looks quite bleak. If insurers didn't offer premium finance, people would have to put the premium on their credit card, and that doesn't necessarily feel like a good alternative, or they'd need to go and get a high interest personal loan. So look, I think you're right to raise premium finance and APRs, but from an industry perspective, and I represent the industry feels that through offering APR, they are offering a service to their customers. Now, as I say, detail underpinning that, but it is a service offering that isn't compulsory to provide.
Yeah. Thank you, Judge. Helen, can I just come back to, because I'm very conscious that we have what, like 70% of tenants in social housing that just don't have contents insurance at the minute. You know, which I think should be a concern to all of us, given that that's a group that's particularly vulnerable and impacted by the financial crisis. I was conscious of Paul's comment as well about having this, and James's comment about having this trusted, independent voice. Is there a role for the Money and Pension Service to do more to promote the benefits of appropriate contents, building insurance? You know, obviously the travel, which is there certainly more to be done there on contents particularly?
Yeah, absolutely. I think just from listening to Paul, Martin and James then about some of the points that they've raised about it being an education piece and there's trust in the market, certainly the schemes that we do offer simple application forms. It's a case of 3-4 questions that they need to answer. There's no specific requirements for security to be on the properties. The rating is the same for everybody on the scheme, regardless, as long as you're a tenant or a leaseholder of the registered social landlord. If you select £10,000 sum insured, everybody will pay the same for the 10,000 sums insured. And also, because the premiums are calculated by area, with the premiums being the same, we also look to fix that premium as well for the duration of the contracts. So that could be over 3 or 5 years. So then your tenant or resident is paying the same premium over that duration. There's no increase in premiums or anything like that. on regards to sort of the testimonials and the claims, I think it does come back to the education piece about the trust within the sector. And the reason we sell them through registered social landlords is because tenants and leaseholders generally have the trust within the registered social landlords, opposed to us selling it direct as a direct policy within the insurance market. Another thing just to point out is there's no interest rate. There's no interest to pay on the premiums, whether they pay them weekly or monthly or annually. The option's there. The premium is what the premium is, and if they, generally they're paid with a payment insurance card at your local pay point zone, and that cost as well can be, I think it's 48 pence per transaction. Now, some of our schemes premiums are only 48p per week. So in order to pay, an additional charge when you go and pay at the pay point outlet, that is actually absorbed by the registered social landlord and paid for by the commission that they earn from the scheme, to eliminate any additional charges being passed on to the tenant or leaseholder. Now, the take up across the schemes, and this is a general view in the market, is between 10 and 12%. And we perceive there's another 10 or 12% elsewhere that have maybe gone, direct in the market. So there's about, I'd say, like Johnny was saying, there's probably about between 70, 75% of people in the social housing sector that have no level of insurance at all. Now, these schemes are specifically designed to cover, it's the smaller things. It doesn't have to be a massive fire or a flood or something like that. They can just be offered to cover, accidental damage for a television that's fell off the wall. I mean, we've got the 6 weeks holidays coming up shortly, and there'll be a lot more children at home. If a telly drops off the wall or falls off its stand, have tenants or leaseholders got that spare £300-400 to replace the TV? If they've got people with no disposable income, the first port of call is generally, high places that do hire purchase or a loan that they'd have to take out at ridiculous levels of APR, whereas they're covered for the contents insurance for as little as 48 pence per week. I do think there's a lot more to be done in the market with the different areas. Certainly my sort of area that I look after is within the social housing sector, but we are looking to and working with Aviva, who are our partner at the moment, to offer this product within the sort of private renting sector as well, to give access to more people within the UK, to try and drive up the penetration rates across, to try and cover as many people as we possibly can.
Yeah, and when you talk in terms of 48p per week premium, for example, Helen, is there any compromise in the quality of cover? And,
Yep.
and can you do things like, and if I my own private content insurance, I can have my bikes and laptop and stuff all. Is there scope for doing that, adding these things on?
Yeah, absolutely. It's a fully comprehensive policy. And there is, if they want, if people wanted additional like personal belongings, or they wanted to cover hearing aids, wheelchairs, things like that, that they can also be added onto the policy. And again, the premiums are, we try and keep them as little as possible. I think from the top of my head, they're about 70 pence per week for wheelchairs. Or hearing aids, which is again quite a significant cost in the market. One thing I will say as well, as part of our research that did come back, is you've got average premium that people will pay within the market for, say, your phone. Your mobile phone will be anything between £10 and £15 a month. If you take out your contents insurance by one of these schemes, that is automatically included within it. So there's a high proportion of people paying £10, £15 specifically for mobile phone insurance, whereas they could pay anywhere as little as 48 pence, dependent upon where you are in the UK, which will cover that as well. So it's included. So you're not just getting your mobile phone, you're also getting everything else, all your contents within your property as well, for a significantly lower premium, which is fixed for the duration of the contract, regardless of the claims that you make.
Yeah. Graeme, James, I welcome your comments, and Martin, please chip in too. I mean, do you think that the Money and Pension Service could do more to advocate affordable solutions to lower income groups?
I think very much so. I think that the insurance industry fund their part, our insurance part of the Money and Pension Service, and It was a shame that their annual plan didn't mention insurance within it during the last year. So we have been picking up that with Michael Royce and the MAPS team, I think he's on the call today, to try to make sure that that awareness is out there, the importance of having the cover, the different covers available, how you can save money. All this information is available, and it is better that an independent body does that. Now, we have an Access to Insurance Committee, and MAPS are involved with that, which we welcome. We also try to work with a lot of charities as well. But at the same time, you've got the sort of the national press always keen to criticise insurance, when in fact, you know, it's such a social good. You know, you really ought to, for example, have travel insurance when you go on holiday, or you end up with some incredibly expensive medical bills. And what Helen was outlining there was, you know, a real gem. It's the sort of thing that Martin was after at the start, I think, an insurance which doesn't even charge more if you've got a criminal conviction. It treats everybody the same. It's 48p. It's got really good cover. And I think there, we probably need the government to come in and help and work more with these local authorities and residential social landlords, encourage them to get these schemes in place, because there's not that many in place at the moment, not as many as there used to be, and yet they're really competitive and really helpful to people. As Helen said, if something happens to these families, they're the ones that can least afford to replace the items that they've lost or have alternative accommodation. So I think there needs to be a big focus on supporting this and getting better penetration.
Yeah, I think you're right, Graeme. I think James made the point earlier on about £500. I mean, which speaks to Lloyd's. That actually is the amount of savings that 80% of their customers actually have. Martin, have you got a hand up? Can I bring you back in?
Yeah, so I think we can learn here from retirement and education. We've eventually come to the realization that actually you need to use behavioural economics here and kind of opt out rather than opt in type initiative. And I imagine for the social landlord arena, you probably need some type of okay from either the regulator or from government to do the opt-out approach. And you know, I used to be a teacher. I used to teach consumer skills in the community, and I worked at the precursor to the Money Advice Service. I was disappointed that they didn't have insurance within their strategy, but at the end of the day, I mean, education will only get you so far. You've got to work with people's nature. Hence why we have Nest Insight doing all this stuff around opt-out savings as well, never mind the retirement. If we could move to that, it'd be brilliant. But again, it points to government intervention. And I'm really sympathetic to industry, actually, and I'm very sympathetic to what James has said on behalf of industry. But we spend our time banging our heads against a brick wall with the social policy makers industry says needs to get involved, and we can't get industry in the room with us to help us get government to do it. So can we join forces here and actually, you know, make something happen? Because I've been working on this probably 15 years.
Yeah. So look, Martin, if you can get the meeting with the people who need to do the opt-out model on tenants' contents insurance, I can again only speak for myself, but based on this conversation, I'm sure Graeme, Helen, and I would join you.
I'm not so hot on the opt. I don't know so much about that side, but I can get
but the point is, there is a demonstrable good being offered by the insurance industry in terms of the example of tenants' contents insurance, which I would appreciate is not your particular area of focus. But I think Helen said that the sign-up rates are woefully inadequate. Why is that? For something that, you know, one might, with some justification, ask if it's too good to be true. But the industry has stepped up to the plate, is offering something meaningful, affordable, and, you know, genuinely helping to protect those least able to afford the insurance premiums that you would get in the normal commercial market. And yet people don't buy it. Now, I've said before, and I will say it again until I'm blue in the face, Helen, Graeme, me can sit on calls like this ad infinitum telling you, or anyone else who wants to listen, the benefits of these types of schemes. It's not us that people need to hear from.
I think the one organisation that could make the difference is the Financial Conduct Authority. And I'm not sure if they're tuned in right now, but you know, back in, I think it was perhaps 2016, that's when you weren't allowed to do the opt-in anymore. that was effectively banned. And so, and then of course, affordability testing is introduced, and all these things, while they might mean well, have actually got a serious unintended consequence for this part of the market. And I'm sure you could map that opt-out change to the number of residential social landlord schemes falling off a cliff. So if there's a way to, whether it's a carve out or just have a look at this again, we're very happy to sit around the table with the FCA and say, let's find a path through so that we can get more people this very, very low cost protection. And I'm sure it could be done.
Yeah. Well, let me hold my hand up because I'm a member of the Financial Services Consumer Panel, and I own general insurance on the panel, and I'm very happy to kind of take that action forward and try and initiate a conversation with the FCA. I guess to some extent, if the other thing that I just noticed there's a point I think that Jake made from the Fair Finance about. Do you want to just come on and just mention that you rather than just the piece that you put in the chat? Would you like to just come on and raise that point?
Yeah, it's just, I mean, really in support of a lot of what Martin was saying. I mean, I think there's just a few kind of examples off the top of my head around where some of the issues become circular for people in vulnerable circumstances. If people in inner cities are living in so-called cheaper areas, then their insurance premiums are higher, and it's that kind of trap that we're talking about. And to me, that's a great indicator that the issues that we're talking about here are systemic, and therefore, as a lot of the contributors have said, require a lot of people to sit around the table and talk about those issues, be open about them, and come to collective solutions on them.
Yeah, thank you, Jake. I'm just conscious of time, so let me just bring in one last point, and then we'll break for our break for 10 minutes. Nabi Obida, can I just bring you in, please?
Sure, Nabi Omidwa, I'm from University of Leeds. I have a question about the risk assessment aspect of insurance. In University of Leeds, we have a project around the use of AI and technology for financial vulnerability. And one thing that we observe is that in terms of making assessments or building models for risk assessment, inaccuracy in such system usually causes extra interest rates or extra cost for financial products. I'm not an expert in insurance risk modeling, but the postcode example is actually one example from a statistical perspective that is a very strong predictor of risk. But here we are dealing with individuals, and that is not necessarily a nuanced model to actually do the pricing based on this attribute. So my question is that to what extent doing a more nuanced modeling of risk can actually help in bringing down the cost of insurance products or financial products in general?
I can take that one, Johnny. No, it's a really good question. And I think in some respects, what you're hitting on is one of the challenges that the market is increasingly needing to grapple with in the context of developments in AI. And that is that for a couple of 100 years now, insurance has been a business that prices risk and people join a pool of risk, and the premiums of the many pay for the claims of the few. But on the one hand, you've got consumer demand that says, well, I'm not interested in paying for the claims of other people. I just want my claim paid. But that's not how a pooled insurance model works, right? And you've got this demand for increased individualized risk pricing, which fundamentally contradicts an insurance pooling model. And then on the other side of the coin, you've got an insurance industry that's increasingly able to individually price risk. And I think, again, it's slightly at the risk of sounding like a broken record, this for me is a big social policy question. Because it is for society to decide some of these questions around how our market responds to some of these challenges. Now, we are doing some thinking about that from an insurance industry perspective, but we need regulators, civil society, and politicians to engage in this conversation at some stage, right? So that may not specifically answer your question, but I think it's a really powerful challenge of the now and the future.
Yeah.
Thank you.
Thank you, James. I'm just conscious of time. I've seen a comment from Michael Royce, the Money and Pension Service, in the chat, and Michael's basically the Money and Pension Service has a focus on insurance as part of its corporate plan for money guidance in 22-23. We can take people through our own services and in partnership with others as close to the market for insurance and elsewhere, but we can't change the market where the focus ought to be on social policy. I mean, basically, I think Michael's basically is reiterating the point that James and Graeme have made, that we all must work together on a solution. And I think, speaking for the financial inclusion colleagues, I think we'd certainly agree with that, and that's something we need to work on. At that point, I'd like to thank Graeme, Helen, and James for joining the General Insurance panel. Ladies and gentlemen, we're now going to take a break for about 10 minutes. We'll come back at 12:30, and we'll then talk about another key area of financial resilience, and that's income, improving people's resilience to income shocks. Well, Ron, I can now say it's got to a dizzy 27 degrees here.
Has it? It was, let's see, that's a bit over the top for you, isn't it, Johnny?
Oh, very much so.
33 in sunny Essex.
It's 35 in sunny Kent.
Heidi, I'm conscious. I've got a private message from Megan about the timings. I'm conscious that the secretariat timings are different to yours slightly. But it doesn't matter, you know. So hence I've kind of gone midpoint.
That's fine. We actually did. We started sort of 5 minutes late, so
yeah.
Just letting everybody come in because it was too hot to get here too early.
Yeah.
So yeah, we're just sort of running about 5 minutes behind, but I'm sure we'll catch up.
Yeah. So maybe we just give it another minute or two, Heidi, I think, and then we'll. Or should we run to 12:35 and then we can start that? Okay.
Yeah, that's fine.
I would have just said Guy Oppam and retweet one of my tweets. Maybe I don't get realize it's from me.
Everybody wants a piece of you, Johnny.
I've got my brother-in-law from the States with me at the minute, and he's a golfer. He was over for the Open, but I was just going through the prep with him for this session, and he couldn't believe how poor income replacement support is in the UK.
Shocking.
So Ron, I'll just do a kind of very quick intro, then I'll hand over to you to kind of set the scene.
Yeah, that's fine, Johnny. Mm-hmm.
I was due to come down to Westmoreland tomorrow for a board meeting, but we're doing it online instead. So this is well, I think.
Mm-hmm.
Okay, Heidi, I think we'll kick off. Right. Well, welcome back, everyone, to the second session of the Financial Inclusion Commission Insurance Workshop, where this session is going to focus on the other key risk factor or risk area that we wanted to look at, which was consumer financial resilience to income shock. And we heard Lloyds Banking Group tell us that the average household now has £500 in savings to fall back on. So that's enough to maybe replace a a TV or a fridge or a washing machine, but it's the cost of half a full car service. But we had the Resolution Foundation, the Nuffield Foundation, and the Centre for Economic Policy report back last week on their Stagnation Nation report, and they called out that there was a desperate need to improve consumer financial resilience to income shock and raise levels of income insurance in the UK, because we were falling, the level of income replacement via the current state provision is at the low end of that provided by countries in Western Europe. And it's actually quite interesting because that report was, came out on Thursday of last week. But today we're exactly 5 years and 1 day beyond the release of the Taylor Review of Modern Working Practices. And the Taylor Review also called out 5 years ago the need for financial insurance, income protection insurance in the UK, particularly for self-employed people. And Matthew Taylor had actually proposed the establishment of platforms, as he called them, where self-employed people particularly could club together to access really affordable, competitive pension provision and affordable income protection provision as well. And 5 years on, we still have exactly the same issue. And so we're joined today to discuss the need to improve income protection provision in the UK, discuss the barriers, and hopefully identify what we can do collaboratively to try and tackle those. So with us, we have Ron Wheatcroft, who's a technical manager at Swiss Re, Simon Hodgson, who's the head of government relations at Unum, Liz Barclay, the UK small business director, commissioner, and Laurence Raeburn-Smith, who's the senior policy advisor on employment at the CBI. And the CBI are very conscious about risk transfer that's gone from government to business, with the need of businesses being asked to improve the physical, mental, financial, and social health and well-being of their employees. So I think we're in for a good debate. So Ron, just to kind of open the topic up, do you mind just giving us a bit of positioning on the need for income protection in the UK, where we are, what we need to do?
Sure, absolutely, and thanks very much, Johnny, and thanks to the Financial Inclusion Commission for inviting me to take part in this. I'm a member, as well as working for Swiss Re on the day job, I'm also a member of the steering group of GRID, which is the Group Risk Trade Body, and I'm involved very much with access to insurance, where I'm jointly leading the group which looks at workplace benefits and how we can do more, get greater participation through the workplace. And it's been great for us that Liz was able to take part in that. So it's lovely to be talking with Liz again a bit later. So thank you for the time on that. It's very good not to be using slides, I think, today on a very hot afternoon, and well done to those of you who stay in the course. I've actually found the session this morning really fascinating, and I hope this one will be too. Just to clarify, because I know there are people on this call who aren't insurance specialists, just to talk about what we mean by group income protection. It's an insurance policy that's purchased by an employer, and what it's actually doing is underpinning the payment of sick pay to a sick employee. That promise may well be contractual, it may not be contractual, and there is ultimately an employer can choose to insure or not insure that promise. Naturally, we think it's good that employers do so, because it helps to spread the cost of risk. It takes out some of the peaks and troughs that would otherwise happen if you were paying claims as you go along. But ultimately, the decision as to whether to use these products to provide cover is generally a result of the following advice from an employee benefit consultant. And in some cases, particularly for large employers, the employer may be recommended that, well, actually, you're big enough that you're going to get a fairly stable costing anyway. And then we have the public sector, which does have some form of sick pay, but that doesn't come to the insurance market. Under the contracts that we have, the employer is the policyholder, and the people covered under the contract are members. They're the employees, of course. And as I said, it's very much a market where employee benefit consultants are key to recommendations. But other financial advisors are important too, particularly in supporting some of the smaller firms. And I'll show you, I'll tell you one or two numbers a little bit further down to show that, you know, while there may be some perceptions that the product is very much around large employers, actually the data that we have show that it isn't. Benefits get paid once a member has been sick, unable to work, for what the industry calls a deferred period. We have the usual confusion with some terminology with this, but then that we see that across much of financial services and of course other sectors too. Typically that would be in the group sector a period of 13 weeks or 26 weeks, and the employer chooses that, and the cost of the cover is partly dependent on the length of the deferred periods. Typically it could pay up to around 75% of pre-disability earnings, and that takes account of other continuing income and state benefits, although benefit definitions do vary between providers and are very much tailored to what the employer wants. So there is no rigid, as company A doesn't say, well, we only provide 75%, for example. It's very much tailored to the need of the customer. And the policy can pay the benefits right through till the expiry age for individual members. Typically that would be state pension age, although you can go beyond that. And I think we are seeing more policies now that are paying for a shorter duration. That's typically 5 years. And I think it's a really good testament to what happens at the moment, that 79% of all insured members have a benefit which in claim can last potentially up to 5 years, provided they continue to be disabled. The number of people covered has grown. Back in 2021, and I'll just briefly touch on the wider group risk market, where we saw a record increase in the number of people covered, which ultimately is the most important thing here. In percentage terms, it was 5.9%, and that was an extra 800,000 people. That's across life assurance and disability policies, rather just disability income, where it was about 128,000 more people came on board. And over a 15-year period from when Swiss Re first collected data and published it, there's been a growth of 68% in the number of people covered. So lots of good news there. Just to bring it into the context of inclusion, the underwriting of cover on these policies operates at a pool level. Generally, we have free cover, which is not free, automatic cover. We're generally up to a certain agreed level, which is partly based on the number of members and the benefits within the scheme. Members are automatically accepted, provided they're actively at work on the day that the scheme begins or the date when they're eligible to join. And the consequence of that is that many people who would otherwise be uninsurable for an individual policy are only accepted with an extra premium. They could be covered, provided they meet any of the criteria to be actively at work. And there are rules in place to ensure that if you're not actively at work on the day, then there's a short period for which you can then qualify. So to come to the point that I made about, is this a policy for large employers? We have heard this from government departments from time to time. Yet just 9% of the policies have got more than 250 members. Going further down the scale, 33% cover fewer than 10 employees. There's just under 20,000 policies in force. So over 6,000 policies cover fewer than 10 employees, and that can go down to 2. 17% cover between 10 and 19 people, and that's an area where we have seen some increases. That grew by 8.8% last year, which is encouraging. And then the further 19% cover between 20 and 49. So we are seeing very much more emphasis on trying to grow that end of the market. But of course, there's far more to be done when you look at the 1.4, 1.5 million employers who employ somebody. There's a bit of a gap here there. Big trend that we have seen has been around workplace well-being. And the pandemic, of course, has been a massive contributor to that. And there's no doubt in my mind that the pandemic has, the impact of the pandemic has been something that the industry has responded to, and that's been a factor in the market growth. I often talk about what we've seen in the past couple of years is that what was essentially a product, i.e. an insurance product, becoming a much wider workplace proposition. It's standard now to include access to an employee assistance program, normally for all workers, access to a digital GP service, very, very handy, the early days of the pandemic and continuing to be used, as well as active management of claimants, potential claimants, really to help them to begin to get back to work. So trying to prevent a claim being a claim in the first place. I don't believe that most people want to be long-term sick, and employers certainly want people back at work. And another trend that we are seeing is rather than medicalising a problem, there's a much bigger emphasis on vocational rehab, and that's good news. And it's been, I was privileged earlier in the year with Johnny to be able to share some thoughts on this market with the Vocational Rehab Association, who I think are doing a great job and will be very influential. And more than this, employers are also seeing the usage stats for the services, so they can see the value that the services are bringing. It's a very good way of understanding, what the value of the wider proposition is. And of course, financially, the sooner people are back at work, you get a positive impact on tax and NI revenues as well. So that's been the big changes. There are opportunities to do far more. We still, I think, suffer from the silo mentality within the industry, in that general insurance intermediaries, I think there's a great opportunity here for general insurance intermediaries to work with benefit specialists much more closely. I think it's the first mention of signposting today, but signposting and referral to specialists to enhance the proposition and thinking of things in a much more customer focused way, I think is absolutely invaluable here. Apologies, Graeme, if you did mention it, but it doesn't do any harm to mention it again. There are some areas where the tax rules are far too complex. For example, it does disincentivize employees from topping up cover. The complexity of it has meant that a number of employee benefit consultants are recommending now to their employer customers that they take that benefit away, because it just becomes increasingly more complex. There's certainly that needs looking at. Another area that I think we could usefully do more on is the requirement to provide a day one statement, so people get told what the sick pay arrangements are when they join a new firm. Now that's fine. I think it's a good idea, and I think it was a real shame that that came in from the 1st of April, just over 2 years ago, just as we were in lockdown, and it wasn't really the top of mind for anybody. I do think that, and this is a personal view, that reminding employees of the benefit can only increase the perceived value of that benefit. And I think people should be told when benefits are changing as well, because at the moment there is no requirement to do that. I know one or two smaller restrictions around how EAPs can be used by family members. And I think that's an area just to think about as well, because sometimes the problem can be between the employee and their spouse or partner. So that can be a little bit difficult as well. So overall, I think we've made good progress, but we are still a long way from covering the people that we could. We've got 2.9 million people with cover on an insured basis. Do those people need to know that the cover is insured? No, probably not really. They do need to know about all the other services, and hence it's kind of become the underpinning of a much wider employee proposition. So I'll just leave it there and happily join in the discussion which follows. Thank you very much for listening.
Ron, thank you. I mean, I was conscious when you said there's about 2.9 million people who've got insured benefits via the workplace. What do you reckon the self-insured, think of the private sector, the public sector, how many people benefit from a self-insured solution from their employer?
Well, public sector is probably, assuming people who work in the public sector get cover, it's probably just over 5 million people more.
Yeah.
And then in the private sector, there'll be some large employers that do this, very large employers primarily, because we see this just occasionally when the schemes come to market for quotes, just to test the market, essentially. And there's probably thousands and thousands of informal arrangements around where an employer might say, well, if you're sick, I'll pay you for 6 months.
Yeah.
And that, I think, is the really difficult part to try to understand.
Yeah.
By its very nature, there are no data available for that, unfortunately.
No, that's great. I'm just conscious that we're looking at what circa about 80% of the UK workforce does not have an income protection solution and is reliant then on statutory sick pay. But that's on the proviso, of course, that their earnings level is high enough to qualify for statutory sick pay. And I'm very conscious that we have a swathe of people that they don't, and probably the vast majority of them will be women. Which is an issue.
And if you look, Johnny, at the self-employed sector, I mean, this is, I'm no actuary, and this is really based on some broad assumptions, but it would appear that around about 10% of self-employed people have a form of income protection policy.
Yeah, I think it's worthwhile as well just remind ourselves, when we're talking timber statutory sick pay, we are talking what, £99, 25, 35p a week for 28 weeks. We currently, as far as I understand it from the TUC, I think we have about the third lowest level of statutory sick pay provision equivalent in Western Europe. And I think the other kind of concern, given the amount of focus we put on pensions in this country, is to realise that 1 in 8 people are going to drop out of this is TUC stats from March last year, that 1 in 8 people are going to drop out of the workplace on ill health, disability grounds before reaching state pension age, which kind of again speaks to, like, I think the point made by the Resolution Foundation that we do need to address this issue as a priority. Let me bring in Liz, if I may, our Small Business Commissioner, because I'm very conscious that, I kid you not, I mean, 5 years, a week and a day ago, Matthew Taylor did make the point that, again, we needed to do something about closing the income protection gap in the UK, and there needed to be a huge focus on self-employed people. And he put forward the fact that there was no reason why platforms couldn't be established to give self-employed people access to better terms on an affinity basis, group basis. And there's been really no progress, I'm aware, that's been made in that. So, Liz, I wonder if you could just comment on the income protection need that self-employed people in particular have.
Well, there is little resilience for the 90% of the self-employed people who, as Ron has just pointed out, don't have any income protection. And we lost about 750,000 to 800,000 freelancers during the pandemic because of income shocks. And of course, it's not all about ill health. It's about losing income. It's about losing clients. It's about losing customers. And I think of those self-employed people who left the sector, they probably, a lot of them reported as little as 10% of the income that they'd previously had before the pandemic started. I noticed Jane Tully was on the line earlier, and I don't think she's there now, from the Money Advice Trust. And of course, they run Business Deadline. And Business Deadline, we've always said that small businesses, and particularly the self-employed, are one electricity bill away from failure. And so, everything you've said about individuals and everything Martin has said, in effect, applies to the self-employed, the freelancers, the sole traders at that end of the scale. They have much more in common with those individuals than they do with the medium-sized and the bigger businesses. And I think that's something that policymakers quite often forget. And when they are talking about businesses, they're talking about bigger businesses with the capacity to have a financial controller who can be thinking about, how can we give protection to our very valuable employees, without whom we can't function. Sorry, I'm in Glasgow, it's quite hot. I've got a frog in my throat. Ron and Johnny, I sympathize with you. But just about everything that's been said, and actually, Johnny, just to pick you up on something you said, you talked about inflation hitting 14-15%, for many of the small businesses and self-employed people that I'm dealing with at the moment, they're talking about inflation of 30% already, because the materials have gone up to such an extent. You know, they're not the people who are grappling with the general level of inflation. So talk about inflation, you talk about the cost of doing business, you talk about the skills shortages and the lack of competition to be able to attract the skills that you need. Your business isn't resilient. And then on top of that, you're thinking about insurance. Now, any kind of insurance is it's up for grabs. It's a conflicting situation, because if you think households on average, there are probably about 17 different insurance policies that you might need at any one given time. In a small business, there are lots of others. What about PI insurance, cyber insurance, we've already mentioned. PI insurance has gone up to such an extent that it's next to impossible to afford. What about credit insurance? That's becoming absolutely impossible for most small businesses. So there's so many conflicting priorities there. And I was really struck with what Paul Wolfe said. We're in Glasgow for the World Conference of Credit Unions. He is, I am, Robert Kelly is. So there's something to be said for what Paul said there. But actually, similarly for small businesses, if they are members of membership organizations like the FSB or the Forum of Private Business or IPSE or the CBI or whatever, those organizations will be looking for insurance options for them and working in partnership with insurers, etc., etc. But membership of those kind of organizations is dropping off too, because that's another conflicting requirement when it comes to resilience. And small businesses are simply having to make the kind of choices that are leaving them with less and less protection. Now, as a freelancer, I've always had income protection. I was really lucky that somebody I trusted said to me a long time ago, get yourself income protection. I've never had to claim on it, but there are an awful lot of small businesses out there, and I know because I was part of some work that we did in the past I was part of the insurance fraud task force, and then we did some research for the CII. And I do know that there's a big trust issue as far as insurance is concerned. And it's partly because of this whole thing that you feel as if you're paying constantly for premiums, but you're never going to get any of that money back. And so I do think that the argument that a trusted third party comes along and says, what about protection? You need to build your resilience. Here's how you might do it, is something that needs to be considered. But I've got so much more that I could go on about. I think I said to Johnny the other day, what we actually need is a catastrophe re, never mind a flood re or a pandemic re or a whatever re, because 1 in 5 small businesses now, I don't know where I got this figure from, but certainly I remember the interview on You and Yours, I did it, and whoever had done the research, could have been the ABI, I don't know, said 1 in 5 small businesses do not recover from a catastrophe. They a flood, a fire, whatever it might be partly because the insurers take so long to get the money to that small business that their customers have moved on. The goodwill is gone. The customers have found another source of their supplies. And so very few ever come back from that kind of catastrophe. And I think there's an issue there for the self-employed and freelancers in that we actually need to get the money within 15 days, the same as we do if we sell our services or our goods to a bigger customer. You know, we need to get the payments in much more quickly. And the cost of doing business has made that more imperative now than ever.
Yeah. Thank you. Laurence, can I bring you in? Because Liz has given us the small business perspective, but from a larger business perspective, from a CBI member, I mean, I was conscious that the CBI had, when I met with them, were talking about the risk transfer that they were, and costs, extra costs passing to business, and thought that income protection insurance may be a means of mitigating that and better managing that risk transfer and the subsequent cost. I'd welcome your view. What do you think are some of the big business barriers to to the take-up of income protection solutions for employees?
Well, it's yeah. Hi everyone. It's quite a similar case to what Liz set out for even those at the bigger end. There's this push-pull that the cost of living crisis is having on businesses, where on the one hand you have far more that you need to do for your employees, and far more benefit that you can get out of doing that. And on the other side, you have the skills shortages, the supply chain issues, the 10 times your pre-COVID debt levels if you're an SME. You're in a very difficult place to be able to go out and buy what are, in some cases, seen as optional add-ons rather than necessary pieces. So it's really a conflict between those two that that employers are grappling with. That being said, there was a really interesting report by Willis Strauss Watson last week that showed that 83% of employers are highlighting financial well-being support as a major focus over the next 2 years. And maybe that suggests that the dial is shifting on the aggregate towards these sort of products. For one, there's obviously the clear moral case in a cost of living crisis that you need to protect those workers, and certainly those who are suffering the most at the bottom of the income distribution. But there's also a clear business case, one as a tool for retention, but also if you see the capability for attraction within the context of the recent labour market trends, with an increasing number of older workers leaving the labour market and an increasing number of people leaving the labour market because of sickness, as well as we've already mentioned. That's quite interesting from a CBI perspective, because that it becomes an element of EVP, employee value proposition, that's not so zero sum. It's not just a part of your EVP that you can use to attract workers from another business to come to yours or prevent that churn. It's a part of EVP that can be used to unlock the economically inactive, which it has a huge macro benefit because it's unlocking a bigger pool of labour. So yeah, it's certainly very interesting. In my conversation with members, there has been a lot of that discussion between, well, we want to do it, but we can't afford it, but can see an increasing need and increasing pressure to do it. And then also, I think it's quite clear that there's quite a lack of understanding about it as a product, both amongst HR managers and employees, and also some concerns, as I think Ron might have mentioned, about how these products interact with universal credit and tax, and will they be effective for those you most want to protect in your workforce. So yeah, really interesting, and keen to engage in a debate.
Yeah, thank you, Simon. Can I bring you in now, because we've seen Ron framed the issue to begin with, and Liz has talked about the small business side of things, and I kind of mentioned the fact that Matthew Taylor had to some extent came up with a solution 5 years ago for affinity type platform solutions for micro businesses. But equally, Laurence has talked about some of the perceived barriers that big business have, particularly around perceptions of cost. So welcome your thoughts.
Thanks, Johnny. There's a couple of different bits there, I suppose. So one around the cost is we do find that the cost issue is frequently cited as a barrier, but it's not always that it's the cost, it's sometimes the perception of cost. So sometimes we find that employers think that these types of schemes are more expensive than they actually are. I know that there's a frequently cited grid number saying that the average group income protection premium is about £300 per employee per year, something like that, which, when you consider all of the different services and bits of support that have been added to the product over the last 5 years in particular, as Ron was saying, you know, there's quite a lot of value that is got for that £300, plus obviously the income replacement element, which for those employees who end up needing it can be sort of lifesaver. So in some ways, I think it's about getting businesses to fully understand what the product offers, just how much value there is in it, and then making sure that once they've bought the product that they really get all of that value out. And that's something where you need a good employee benefit consultant as well to help that employer to get everything that they've actually paid for and make sure they get the value. And we find that once employers start to really use the services that we offer, so for example, once the employees are signed up to the virtual GP service, once they start using the counselling or the physiotherapy services that we offer at no cost, we find that those employers become much more sticky, and they renew and renew and renew because the employees really value that support, and it's something that they think is a really important part of their health and well-being offer, much more so than free fruit or these other sort of things that sometimes can be quite expensive but not really deliver that kind of value. So I think it's partly about just continuing to educate about just how much value there is in these products as well.
Yeah. Sorry, Simon, you were going to say.
Go ahead.
No,
well, I was going to say you asked about the affinity platforms, and so I think this is another way that, for example, for smaller firms, they can start to think about buying these kind of products in a different way. I think certainly we have to think about different avenues of distribution. So, one of those might be, for example, we might work through banks, we might work through accountants, we might work through trade bodies. What about covering, every plumber who banks with NatWest through a group scheme, and underwriting them all, and we'll have a same premium for everyone. That's the kind of thing that theoretically is very doable. I think what we need first is to kind of drive up a bit more demand. I think that's really what's stopping those kind of solutions coming forward. I don't think there's any legal or financial or technical reason why we can't do stuff like that. I think it's just that the demand isn't quite there yet, and I think that's where some of the government signals probably need to come in first.
Yeah, I think it brings us back to the discussion we're having earlier on. Actually, I mean, Liz alluded to the fact that having a trusted third party that can maybe help advocate the need for this type of income protection solution. I mean, Liz, do you think that's the role for the Money and Pension Service, or is that do we need other groups to join that conversation?
When you get down to the small businesses that I'm dealing with, it's about engagement, and it's next to impossible to engage with small firms that have got so many other things to think about. At 3 o'clock in the morning, a small firm wakes up worrying about how they're going to pay the bills the next day. They're not thinking about how do I increase my bills, my outgoings by looking for some insurance products. So how do we get that engagement? Now, there are only 3 places that small businesses engage with at my level. They engage with their bigger customers, they engage with HMRC because they have to, and some of them engage with accountants, but not all of them. Quite a lot of them engage with the cloud accounting software platforms now. So it's really about how can we get engagement that exists already to get the message through for you, I think, because otherwise engagement itself is a nightmare. You're talking about 4.8 million businesses here that are single people outfits or employ a very few people, as in micro business level. But that is equally 4.8 million plus the ones that have 0 to 9 employees. That's 40% of the workforce, and that's too big to fail. So we have to build resilience into that sector.
Yeah, and I'm very conscious at the minute. We had some of the Rishi Sunak initiatives about leveraging business schools to inject some skills into micro businesses. That seems to have fallen by the way. I've heard it's all gone quiet. I've heard no more about that. But when I did look at the curriculum for that, there was nothing about risk management.
No.
On this,
but there are a lot of other organisations working with the business schools to try to do precisely that. So the Freelancer Club, Underpinned, etc., are all already working with, and I'm busily putting them all together to see if we can get them all on that page, because there's nothing that actually looks at the very, very basic stuff You know, what insurance do you need? How do you get paid? How do you invoice? All that very basic stuff doesn't come onto the curriculum in most business schools yet, but I think there's a gap there.
Yeah, I mean, you raise a fair point, Liz, because I'm conscious of those kind of freelancer forums. We need equally things like, you know, a lot of the university incubator programs and things, which have got stacks of small businesses in them. But there's, you know, this is where we've a distribution failure, I guess, to some extent, because the type of employee benefit consultant that Simon alluded to, we're not, you know, we haven't got anyone really talking to them at the minute. And I think Ron made the point earlier on about what he's been doing with on the general insurance brokers, because to some extent those guys do have a relationship. So maybe I think we've got a fund at this small SME level. We have got this distribution engagement issue we need to try and tackle somehow.
But then again, Johnny, we've got 800,000 small businesses started up this year because people have been made redundant or suffered income shocks and have decided that they must create an income for themselves somehow. They're not going through business schools.
Sure. Ron, any thoughts on how we might tackle this distribution issue?
Yeah, I think we need to think more like our customers, for one thing, because our customer. I mean, let's take a business, and I agree with everything that Liz was saying. But business customers have to have some insurances because it's the law of the land, and it feels to me that if you're employing, I don't know, 10, 20 people, if that person that is absolutely key to the success of that business dies, becomes disabled, can't work, it's not just that person who can probably make some provision for themselves, but it's the whole business can go down the tubes. Now, if that happens, I'm not saying this is more important or less important than providing some benefits for the workforce, because that's a wider debate, really. But I do think that this really ought to be part of the thinking around the wider proposition. And sure, I do agree with Liz that, you know, there's choices to be made here, and I guess many people every day of the week now are making choices about, well, what cost do I have to trim, just basically to survive and keep food on the table. But I do think if we had a much wider proposition, we tend to be, as an industry, very much focused on that's general insurance, this is life insurance, and some of the communications we see reflect that. I've seen things, for example, about protecting businesses from the ABI, and this is not to knock ABI really, but and there's no mention at all of the key person risk. Key person dies, doesn't get a mention, and it's just to take one example of how we still, I think, tend to be much more driven by working in silos. I mean, a poor old customer probably gets bombarded with different people from different parts of the insurance sector. And I'll mention signposting and referrals again, because I do think that's one of the possible conclusions. Now, we're still waiting on the Consumer Duty final rules and guidance. But one thing I think we do know is that some of the smaller businesses will definitely be impacted by this. By the rules and guidance. And I think that provides an opportunity just to rethink a bit more about how we access them, what we do for them. And you know, let's be honest, for all the difficulties in the workforce, there's still a premium on good people. And I would perceive that we are where we are now with workplace well-being. I believe we're there to stay. And I think it's going to be quite hard for many employers to take away benefits, particularly the softer benefits that people use. And if insurance becomes the backstop, then that feels fine to me. I don't have too much of a problem with that. It doesn't have to lead. But I do think that, you know, this whole piece just needs a bit of a rethink about distribution. You know, we've got very good distribution and in the intermediary market, and they're members of Grid, and they do a great job, not just in terms of their customer relationships, but also contributing to trying to improve the market. But it's just not enough of that gets through to the end customer. So if we could kind of build on that, I think that will be a big help, Johnny.
I think to the point that you raised, Laurence, about the need to bring to encourage people to stay in the workplace, rehab them back into the workplace quicker. And if you look at there are a number of government-backed supporting healthy aging, living and aging via the workplace initiatives on the go now across a variety of universities. Maybe it's maybe one to bring Simon as well. I mean, how do we link up that kind of policy agenda and kind of develop the need for government to support things like income protection as a means of keeping people at work and rehabbing them quicker as well?
So Johnny, I'll jump in if that's okay. Okay. I think I think most people agree that we're kind of heading towards some kind of recession, or at least there's a big risk of a recession. One of the things that's fairly well established in the in sort of the literature or kind of economic studies across various developed countries is that when there's a recession, there's normally in the kind of following few quarters, you start to see an uptick in health and disability benefit caseloads as well. And there tends to be a kind of health and disability benefit caseloads as a sort of proxy for unemployment that comes in after a recession. And I think we have seen that in the past, and I can see Ron nodding, so he's got a lot more experience in this market than me. So that's something that we clearly have to be concerned about coming in the future, but it's already happening now. I mean, various people have already talked about the sort of numbers who are leaving the workforce for health reasons. Often over 50s are kind of just ruling themselves out of work from where they are now until state pension age. They may be able to afford to do that, they may not. It's not really clear, but certainly we're seeing massive rise in economic inactivity from that group. And at the same time, you know, I think people who've been following the Conservative leadership contest will also be familiar with sort of conversations going on about welfare at the moment. But the reality is, you know, most people who are on welfare are on health and disability benefits. So these are people that have already kind of left the workforce for health reasons, and maybe there hasn't really been the attempt that there should have been to try and keep them there in the first place. And all of this different economic inactivity is costing us billions and billions of pounds a year. In 2016, the cost of ill health preventing work was 130 billion a year. Most of that was lost productivity. I think it's about 86 billion in lost output. And so really, there's no reason not to get on top of this problem as quickly as possible. And I think anyone who's been around health and disability issues for a while knows that it's far easier to keep people in work than it is to get them back to work once they've already fallen out and fallen away from the labour market. You know, DWP tries their best, but it's very difficult to get people off benefits and into work, because by then they've been out of work for a long time. That link with the labour market and what they used to do has kind of been severed. So insurance is really the answer to this problem, because we have a massive incentive, and I kind of try and explain it this way because I think it's sort of I often see light bulbs going on in the government officials' heads when I kind of explain it this way. We have a massive incentive to keep that person in work because we have a sum assured on that person from now until their state pension age that could be, you know, well over £1 million. So we're quite happy to spend quite a long time working with them and with their employer and trying to work out what the barriers are to getting those people back to work. And so from a kind of unit cost sort of basis, this is quite a compelling product in the sense that we're prepared to spend almost limitless amounts of time trying to retain these people within the workforce. And so to get that kind of benefit for the costs that group income protection actually represents from the government's point of view is very compelling indeed. And so I think Liz kind of hit it right when she mentioned HMRC. I think that the combination of kind of HMRC, DWP, SSP, the kind of, you know, fairly limited reform of kind of those sorts of areas, so potentially a sort of tax rebate here and an SSP tweak there. I think the kind of combination of those things is what's going to kind of bring sort of wake SMEs up, I think, to this, and they can start to really see that there's potentially a big cost over here if they don't do something, but actually we're helping you over here to try and get some support in place. I think that's the thing that's going to bring SMEs particularly into this market for the first time. And I think once you see that kind of influx into the market of a large number of businesses, I think some of those distribution challenges will start to sort themselves out quite quickly, because I think there'll be a mad rush to try and secure that custom.
Thanks, Sam. Laurence, what, you know, from a CBI perspective, what's your take on that?
Well, yes, it's a similar thing that we're hearing from our members, to be honest. Once you have the scale, it will obviously be a lot easier to plug together and get there. But it is about driving that demand in the first place and making sure businesses can actually afford to do this within the constraints of cost of living, cost of business. Clearly, there is a need there for it, but that need needs to be married with good education. So employees need to know that it's something that they should be asking their employer for, and employers need to know that it's something that they can offer to those employees to actually get them on that journey. So yeah, it needs to be clearly there's a need in the market there, but we need to activate that demand, and then from there hopefully we'll get the scale necessary to run with it.
Yeah, thanks, Liz.
I just wanted to caution against thinking about policies for the way we work now, because it's changing. The whole workforce is changing. We need to think about young people don't want jobs. They want to work. They want to be in work, but they want to do gig work. They want to do some self-employed work. They want to do, they want different roles. And we're beginning to call it the braided workforce, so there are different strands that are all braided together in the way that you work in future. Now, that's going to demand some ingenuity on the part of the insurance sector in order to cover all of those portfolios that people are putting together and want to put together.
Yeah, I think that's a very fair comment, Liz. I think certainly the other thing that I noticed very much from the work I've been doing within the FCA, Financial Services Consumer Panel, was and some comment I saw from Nest was the fact that even for employees now, fluctuating income is very much the norm, and particularly the lower down the income scale you tend to go, the higher that degree of fluctuation. Which is, I know a lot of these income protection products have been very much focused in the past and on a linkage to a level of salary. And I think maybe for some, there's maybe a need to refocus now on what actually are the person's outgoings, which will present some challenges. But I think maybe there's certainly a need to look at that, given the fluctuation the income fluctuation that people are now experiencing. Ron, Simon, any thoughts on that?
Yeah, I think that's a very valid point, Johnny. I know we probably use income as a proxy for outgo, really, because we spend our income or a high proportion of it and save some. I do think we need to look at that, because sometimes I think we can be guilty of selling the perfect or advising on the perfect solution, when maybe should be looking at if there are better ways that we could prioritize this. I mean, this is very much in the world, I think, of individual policies and individual financial advice for people. But we don't really see many people protecting their commitment to monthly repayments of their mortgage. We do see quite a lot of people covering their mortgage against financial consequences of death or disability. There are some companies that have package products where you can buy some life cover, some income replacement, but I don't think we really look at it for the most part, other than as accrued. Well, we'll just take the death or disability lump sum risk out. So I think there is lots of scope to do more. We do need to be careful with all of that. I mean, as you and I have spoken many times, Johnny, the complexities of how the income protection payment, whether it's from a group policy or an individual policy, links with universal credit. So particularly for lower earners, there can be the risk that the benefit entitlement that they have is severely reduced by the fact that they've got an income protection policy. We have made some progress in getting some dispensations and disregards, but I think there's a long way to go with that. So while I like the idea, we just need to be sure that we don't get drowned in some of the complexity that unfortunately we still face on individual benefits, which can really preclude people below, I don't know, £15,000 per annum maybe, from people from advising them because of the risk of misbuying or mis-selling.
Yeah, but I think I was quite taken with your comment, Liz, that small businesses are too important to let fail. And I'm hearing a lot of talk at the minute from regulators and politicians about the need to support consumers impacted by the financial crisis. Do we need some sort of initiative to support business, specifically business impacted by the financial crisis? And really, it's a kind of final point before we wrap the session up, because we're out of time. What would, from everyone really, what would a key plank of that be? So maybe, Liz, if I start with you.
I think I'm going to have to forgo that one because I'm not supposed to comment on policy requirements.
Yeah.
But what I would say is I have an awful lot of small businesses saying to me at the moment, the government's got to do something to help us. And I am talking to small businesses that are telling me that things have got to the point already where they can't take home a salary. So if they don't fail because the business has no money, they're going to fail because the household has no money. And the last time we had a small business recession like that, we saw a vast number of repossessions of homes. I think something like 76,000 a year for 3 years or thereabouts. And we saw a huge number of people made homeless as a result. And the mental health issues that are coming down the track are absolutely astronomical. And somebody has just put on the chat, to the point about generational shifts in the world of work, keynote speech at the Wellbeing Congress last week, reported Generation Z will have on average 17 different employers and 5 different careers. And that's a big, big shift, and how are we going to manage that? And of course, if businesses start to fail, then we'll see that work shift speeding up.
Yeah, thanks, Liz. Simon, do we need a small business, a business task force, and should IP be part of that agenda?
I think absolutely group income protection and health and well-being needs to be part of that. I think it's very interesting to talk about the kind of shift to this kind of multi-stage life, portfolio, career, etc., etc. I think part of the reason people are going that way, and this may be kind of a cynical view on my part, but part of the reason we're going that way is because employment maybe is not what it used to be, and people don't feel as secure in employment as perhaps they once did. And I think one of the ways we can really turn that around for kind of traditional employment, if you like, is to make sure that there's a really, really strong health and well-being and financial resilience security offer there for people that they feel actually that's worth staying with. And it's something that they value a lot. And as Laurence was saying, something that employees or prospective employees know to ask about. I think in the UK, we only really talk about salary. It's very rare to go to an employer and say, well, am I going to get such and such an insurance? In countries where insurance is more commonplace, that kind of conversation at recruitment is more commonplace as well. So I think it's definitely important that we try and make health and well-being part of what we're doing in the future with small business. And I suppose that the risk is that small business sees that as just another burden, just another cost. And so therefore we have to come up with a way. Unum has set out how you can do this with SSP by changing the way SSP works. You can kind of tax the really, really bad performers, and then use the kind of savings you generate from increased tax and NICs that you get through SSP to give small businesses a lot more incentive through maybe vouchers or through tax incentives to put support in place before something is wrong. I think that's the other reason that we need to kind of take action now. If we imagine ourselves 6 or 12 months down the road where the economy is even tougher than it is today, some of these business owners are going to have mental health problems, and they would be glad that they had put something in place that they can access as well. It's not just about the people they employ. So the sooner the better, I think, so that we're prepared when this happens.
Yeah. I'm just conscious of time. Liz, can I thank you, Ron, Laurence and Simon for joining this debate. And let me now hand over back to Chris, the chair of the Financial Inclusion Commission, maybe just to kind of comment on this insurance discussion and give some final comments. Chris, back to you.
Yeah, and thanks to you, Johnny, for both organising much of this and for excellent chairing of the discussion, and to all of those who've made contributions today to what I think has been a really rich discussion and a lot of interesting issues that have emerged. And thanks to all those who've joined the discussion as well. We had as many people after 2.5 hours as we had at the beginning, and that is a real credit to the quality of the discussion. I'm not going to try and summarise. You wouldn't want me to, because you've sat there for 2.5 hours already, and I'm sure you want to get out into the heat wave. But let me just say one or two general comments. First one, on the first session on general insurance, very clear that everybody understands the problem, and Martin outlined it with great, in a very articulate way at the beginning, and well done for that, Martin, for everything you're doing on it. It's clear the industry is doing much to address the issue, but as James said from ABI, the industry cannot stop people being poor. And therefore we do need, and I think it is Martin also made this point, we do need a partnership between the industry, between government and regulators, as well as the consumer bodies, etc. And one thing that government could do, as Graeme pointed out, was to cut the insurance premium tax. I haven't heard that as a proposal from any of the leadership candidates in either of the debates so far. And as we at the Commission continually suggest, the FCA as the regulator must have regard to issues of exclusion and inclusion, including this aspect. Second session this morning, opened by Ron, talking about the benefits of insurance-based income protection, but also pointing out just how limited the coverage is. And a number of contributors pointed out that that means that many of those schemes are themselves not particularly sustainable, or not as sustainable as they could be, because you need as wide a coverage as possible. And that is particularly the case, of course, with the self-employed and small business. Liz has trained me not to describe them as SMEs, because they are micro businesses for the most part. And she pointed out that there's a big gap there in trust. And on the employer's side, whether it be the self-employed or employers, there is an issue about the perception of the cost of such schemes, whether or not that is a reality or not. We had some discussion about whether or not we could find a way in which trusted third parties could be brought in. And with Michael Royce here, I think Money and Pension Service was in the frame for that. You're doing a lot on it, Michael. Maybe there's more that could be done, as well as HMRC, DWP, etc. We ended with that really interesting discussion about whether this is relevant in the world of Generation Z and the changing workforce, and the point that Jake put on the chat, which Liz repeated. Generation Z will expect to have 17 different employers and 5 different careers during their lives. I frankly feel I'm in that position currently, never mind over my working life, but it does mean we have got to think about ways in which we can devise those income protection policies in such a way that is relevant to the world in which people are now living, not in the world that existed in the 1950s. So there is a huge challenge there. It has been a tremendous session. We will be making the recordings available for those who would like it, and we will try to draw out in a summary some of the key points in a much more articulate way than I managed to do in the past couple of minutes, just so that we can take some of that away. And certainly the Commission would want to work with all of you to continue on what I think everybody has agreed is a really important initiative. We need to get this right. We need to give people greater resilience, especially as they go through the challenges of the cost of living crisis. And who knows when the next pandemic will be hitting us, whether it's an economic pandemic or a health pandemic. So thanks to all of you for giving up your time. Thanks again to Heidi for organising it from absolutely admin. And let's all stay in touch and make sure that we can take this debate further. As I flagged, we will be having another of these online summits in the autumn, which will be around the issue of financial education, both in schools and also throughout life. So please keep an eye on the Financial Inclusion website, keep an eye on Absolutely Admin's website to see when that is happening. And if you can join us for that, it's great. But whether you can or not, stay in touch. We need to work together on this. And if we do, I think we can achieve a lot. Thank you all. Have a good afternoon and stay cool. Thanks.
Thank you very much.
Thanks, everyone.